When we last looked at SoundHound in early July, we had a buy rating on the stock with it showing 23% upside, but it blew through our base case and skyrocketed 57% in only 4 months for an annualized return of almost 160%. With 2 major acquisitions, an increasing number of name brand customers, and NVIDIA with a stake in the company, is SoundHound stock ready for another big run, or is it time to pump the brakes on this AI innovator? Let's dive in and find out. For those of you that want Wall Street insider analysis and access to my Excel financial models, check out my school community, Win Like Wall Street, which you can access by going to bit.ly/WLWS for Win Like Wall Street. All right, 3 points that we are going to cover in this video. Number 1, background/business model. SoundHound uses proprietary AI technology that let businesses offer conversational experience to customers across multiple languages in multiple industries, including automotive, TV, and customer service. Think of it as an AI version of Siri or Alexa on steroids and speed. Part 2, the opportunity, both positives and negatives, as well as company updates. So the company recently reported record results for Q3 24, but SoundHound has done 2 major acquisitions in 2024, which will have a massive impact on the company moving forward. There are lots of intricate details, and I will break it all down for us later on in the video. This is one of the most volatile stocks out there with a beta of close to 3, one of the highest that I've ever seen. But with increased company guidance and a path towards profitability in the next few years, we will see if the company can hit escape velocity before cash runs out, or if it's doomed to fall short. Part 3, valuation. On Wall Street, we build 3-statement financial models, culminating in a discounted cash flow or DCF valuation. I have built a 3-statement model for SoundHound, and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. All right, part 1, background/business model. We'll start with background. Imagine if every device in your life, from your car to kitchen appliances, could understand and respond to you naturally, making your daily interactions smoother and more intuitive. That's the ambitious vision one company is pursuing. Founded in 2005 by a team of engineers focused on conversational AI and voice recognition, SoundHound AI aims to voice-enable the world with conversational intelligence. Technological edge. Pioneers of proprietary technologies like speech-to-meaning and deep meaning understanding, SoundHound enables devices to understand and respond in real time with context-aware voice AI. Global reach. They power voice AI in 25 languages across industries, including automotive for companies like Hyundai, Honda, and Stellantis, hospitality for companies like Applebee's, Chipotle, and Jersey Mike's, and IoT devices for companies like Planet Fitness, Square, and Toast. Growth milestones. So the company went public in 2022 and achieved a cumulative bookings backlog of $723 million by mid-2024. What is the company's mission? Voice-enable the world with conversational intelligence. And the vision: create a conversational AI platform that exceeds human capabilities, delivers value and delight to end users, creates an ecosystem with billions of products, and enables innovation and monetization opportunities for product creators. Technology disruptor. So SoundHound sees itself as a tech disruptor along the lines of Microsoft, Apple, Google, and Amazon. They believe they are positioned to be the leader in human-computer interaction and the next generation of search monetization. Strong patent protection. So leveraging its deep patent portfolio and robust competitive moat, SoundHound has 270 patents with 155 granted and 115 pending, ranging from important areas such as speech recognition to audio and music. Market opportunity. So the company estimates a voice AI total addressable market, or TAM, for 2024 of $140+ billion, with 2025 connected global devices of 75.4 billion and a 10-year compound annual growth rate of 17.2%. There is massive future potential for SoundHound's voice AI technology. Now, while all this sounds good, and well, I know what you're thinking.
So where's the money?
So the company has 3 revenue pillars. Pillar 1, products. So this includes licensing fees from embedding voice AI in devices like cars, smart TVs, and IoT products. Revenue is based on volume, usage, and lifetime of the product. Pillar 2, services. AI solutions for customer service, voice commerce, and food ordering, such as a drive-through or delivery. Monetization comes through subscriptions and usage-based fees. Pillar 3, ads and commerce. They monetize user interactions via voice-enabled commerce and advertising partnerships. Revenue sharing and commissions occur on transactions. Now, Recurring revenue streams. They do have a heavy reliance on annual recurring revenue, or ARR, from enterprise contracts. These enhanced monetization opportunities come through partnerships and cross-industry applications. And then the flywheel effect. So increasing adoption of products and services drives ad and commerce revenue. This feedback loop creates compounded growth across all revenue pillars. Now, if that word salad has you confused, let's go through an example. So imagine you're driving to work and realize you need to pick up lunch for a meeting. Using SoundHound AI's smart ordering system, you simply say, "Order a large pepperoni pizza from Domino's for pickup at noon." Within seconds, the AI confirms your order, schedules the pickup time, and even updates your GPS to guide you to the nearest Domino's. While you're still driving, you ask, "What's the weather like in the afternoon?" SoundHound's AI seamlessly transitions to its dynamic interaction mode, responding, "It will be sunny and 75 degrees at 2 p.m." Later, as you reach your office, you receive a text notification confirming your pizza order, completely hands-free and hassle-free. So this is a win-win-win. The restaurant gets value because they generated a new lead and booked a sale. The driver gets value because they have placed an order just by speaking into their car. And finally, the car manufacturer delivered value to the end user and generated additional revenue from the usage of their product. So some examples of companies currently utilizing SoundHound AI. Hyundai integrates SoundHound's voice AI to allow drivers to control car functions and access real-time information such as navigation updates and weather. Stellantis, the makers of Jeep, Chrysler, etc., uses SoundHound's voice intelligence for hands-free voice commands, such as checking car diagnostics or setting cabin temperatures. Hospitality and customer service. So IHOP and Denny's deploy smart answering and dynamic drive-through systems to automate food orders, reduce wait times, and enhance customer satisfaction. Snap One uses SoundHound's platform to integrate voice AI into smart home and IoT devices. Technology and retail. Snap Inc. leverages SoundHound's branded wake word technology for seamless voice assistant experiences. And Pandora utilizes SoundHound's conversational AI for personalized music search and recommendations. All right, part two, the opportunity, positives and negatives. So I like to hear the bad news first. Let's get the negatives out of the way. Competition from larger players like Amazon Alexa and Google Assistant. High dependency on key industries like automotive, which are cyclical. Relatively small market capitalization of 2.4 billion, which makes it more volatile to market conditions. Risk tied to potential slowdowns in AI adoption or broader economic weakness. They're not yet profitable, and they're relying on investor confidence and access to capital. So our model, which we'll go through momentarily, does not have the company becoming EBITDA positive until the end of the model in 2028. Pro tip. Always look for filings around the 10K and 10Q, such as 8K filings or registration statements, such as an S3 filing. So in the case of SoundHound, they filed an S3 or registration statement on November 8th. Now, the registration is to sell additional shares of Class A common stock valued at up to $20 million. The purpose is that this filing builds upon a prior registration from July 2023, which became effective in August 2023, under which 100 million worth of shares remain unsold. Now, there's major implications for this, including dilution of shareholder value. Now, I don't want to gloss over this because this is a huge point. And SoundHound has raised $565 million via equity issuance alone. Imagine the equity in SoundHound was a 20-slice pizza pie, and in 2021, you owned 25% of that pie, or 5 slices. Today, you would only own 1 slice or 5% of the pie. So due to dilution, your investment size decreased 80%, going from 25% to only 5%. Now, I cover this extensively in my Win Like Wall Street membership community, where members get my Wall Street insider analysis and access to the Excel models that I cover in these videos. Just go to bit.ly/WLWS for Win Like Wall Street. Now, this also signals a need for cash. With the company's current cash balance of $136 million and the current cash burn rate of $76 million per year, the company has enough cash to last just under 2 years. So expect even more dilution in the future. I'm going to cover this later in the valuation. Market perception. So the positive is that if the funds are used to drive long-term value, such as through research and development for proprietary AI technologies, the move could be seen as a strategic investment. But negative. Frequent equity offerings may signal that the company is struggling to generate sufficient internal cash flow, and that's actually something that we do see with the company. Short Interest. So currently about 78 million shares, or 21% of the shares outstanding, are short, which means that a lot of investors are betting against the company. Investors sell shares short when they think the shares will fall. They borrow the shares today, sell them, and buy them back later to replace the shares that they borrowed.
Not a short sailor, a short seller.
So, as an example, if you sold shares at $6 and the stock fell to $4 and you bought them back, you would make $2 or a 33% return. Insider sales. So, the last insider purchase was on May 20th, 2022 at $4.80 a share. Over the last 2 years, from 2022 to 2024, insiders have sold a total of 4.1 million shares for a total of $15.1 million. The average price is $3.70. Now, if you think this is something that's infrequent, as recently as September 24th, all C-level executives sold a total of 300,000 shares at an average price of $4.89. Let's face it, folks.
There's no sugarcoating this fact.
Okay, let's turn to the positives. Cutting edge technology with proven scalability in enterprise settings. Establish relationships with major global brands in automotive, hospitality, and retail. Positioned in high growth markets as demand for conversational AI surges. Strong revenue growth trajectory and improving financial discipline. Clear path to profitability with recurring revenue streams and cost management. There is significant institutional ownership, with Vanguard owning over $110 million of the company's stock as the number one shareholder, and coming in at number 9, a strategic investor that you may have heard of, NVIDIA, with over $8 million invested in SoundHound. All right, company updates, 3Q24 results and acquisitions. So for 3Q24, what does a record-breaking quarter tell us about SoundHound's future? More importantly, how does their latest acquisition potentially transform their business? All right, record revenue of $25.1 million, an 89% year-over-year increase, showcasing robust growth across key verticals. Customer diversification. So the top customer now represents just 12% of total revenue. Previously, it was 72%, with industries like automotive, financial services, and healthcare each contributing between 5 and 25%. Improved margins. GAAP gross margin at 49% and non-GAAP gross margin at 60%. Cash position. So they ended the quarter with $136 million in cash and cash equivalents. Guidance. This is awesome. Revenue outlook for fiscal year 2024 increased to 82 to 85 million, up from previous expectations, indicating confidence in scaling their business model. Also, the company gave fiscal year 2025 revenue guidance of 155 to 175 million, which implies growth of 90 to 105% from 2024 to 2025. Acquisition of Sync3. So this company has a focus on restaurants. They provide voice AI to the restaurant industry, enabling dynamic customer interactions like smart ordering and dynamic drive-through. Synergies. So this accelerates the deployment of generative AI in hospitality for SoundHound. Acquisition of Amelia in August of 24. So this is a strategic fit. Amelia, a leader in conversational AI, expands SoundHound's reach into new industries like healthcare, insurance, and finance. Now, there's also an immediate impact. They added advanced automation solutions and enhanced cross-industry capabilities, particularly for customer service and generative AI applications. Financials. Amelia contributed significantly to SoundHound's improved customer and revenue diversification in 3Q24. In addition, the combination results in revenue and cost advantages, new monetization opportunities, integrations, and capabilities, as well as 45 million in recurring AI software revenue. All right, part 3, the moment we've all been waiting for, the valuation. So we only have 3 years of financials, so building a projections model and DCF off of limited data is extremely challenging. If you think of a jigsaw puzzle, what do you typically do? You first grab the border pieces, build that out. That's kind of like the foundation or the historical financials where we get trends. After that, you look at the box for the picture and you see what it will become. This is kind of like the future projected financials. Unfortunately, in the case of SoundHound, we're building a 1,000-piece jigsaw puzzle with no border pieces and no picture. So we're putting pieces together one by one. Balance sheet. SoundHound's cash reserves and receivables indicate growing operational scale, but can they manage their working capital effectively? As mentioned earlier, SoundHound has major changes to its balance sheet in the first 9 months of 2024. So I created a pro forma 2024 set of financials. Since we only have 5 weeks left in the year and 2023 is pretty stale at this point to build projections off of, I think this is the right way to go about it. Cash and cash equivalents, starting at 10.9 million in 2023 and projected to grow to 236.5 million by 2028. This indicates improving liquidity. Accounts receivable, projected growth from 4.05 million in 23 to 84.5 million in 28, reflecting increasing revenue from enterprise customers. Other current assets, significant growth from 14.2 million in 2023 to 108.1 million in 2028, possibly due to expansion in working capital. Goodwill and intangibles. These arose from the acquisitions of Sync3 and Amelia. So when you pay a premium for a company, it gets booked as goodwill. Paid in capital. Remember earlier how we discussed the company has raised a ton of money via equity? That's reflected here. Retained earnings. The company will not generate positive net income through the end of our model. We're going to see this next in the income statement. So what's the takeaway? SoundHound has a clean balance sheet with under 40 million in debt and over 136 million of cash and can raise up to 120 million of equity. So there's upwards of 250 million of dry powder available, giving them a nice runway. Let's hop in the model. All right, so as we mentioned, we see a massive increase in cash. Accounts receivable is also increasing, partly due to the 2 acquisitions that they recently completed. Also, we see the goodwill and intangibles, which came from those exact acquisitions. Paid in capital has increased pretty substantially. We're going to cover this a little bit more in depth later on in the cash flow statement. This isn't necessarily a positive because they're diluting shareholders in the process. And then retained earnings, unfortunately, it's an increasingly negative number and it doesn't become positive through the end of our model. Income statement. So revenue has grown by 3.9x over the last 3 years for a 58% annual top line growth rate. In the 3Q24 earnings call, management provided revenue guidance of 155 to 175 million for 2025. This is 90 to 105% growth. Gross margin, which is an indicator of profitability relative to the cost of sales, has increased from 71% in 2021 to 76% in 2023. But with the integration of 2 major acquisitions, it's down to around 60% year to date, with a management target of 70% long term. Now, EBITDA has been negative and doesn't turn positive in our model until 2028. This is a major risk factor that must be considered. Now, it's mainly due to research and development, which has averaged about 60 million per year over the last 3 years. Also, net income is negative too. We're going to see this next in the cash flow statement. So what is the takeaway? Top line revenue growth is solid. Gross margin has compressed some, but the company is integrating 2 big acquisitions. They need to be careful to balance research and development investment in the company with achieving profitability. Let's hop in the model. All right, so significant revenue growth, 3.9x over the last 3 years. A lot of this has come through those 2 recent acquisitions, but we see a massive ramp on a going forward basis, 675 million at the end of the model in 2028. Now, another key thing to note, research and development is pretty significant. That's not something that's a surprise for a tech company like this, but they will have to rein that in over time. EBITDA, which is a very important metric of profitability, doesn't become positive until 2028. And then net income does not become positive through the end of our model. This is something to keep our eye on and be aware of. Hopefully, the company can rein in costs over the next several years and turn that into a positive. All right, next we have the cash flow statement. So as I just mentioned in the income statement, net income is negative, averaging negative 98 million per year over the last 4 years. Along with negative net income, the company has negative operating cash flow, averaging minus 76 million per year over the last 4 years, though it is projected to turn positive in 2027. Now, the good news is this is not a CapEx intensive business because technology produces a service rather than a physical product. Now, equity issuance has averaged 141 million per year over the last 4 years, which dilutes the existing shareholders and is not an ideal way to fund the business. The company has a cash burn rate, operating plus investing cash flow, of 76 million in 2024, which equates to 1.8 years or 21.5 months based on current cash on hand, and 3.4 years or 58 months if we include the equity shelf registration of $120 million. The company is projected to generate positive cash beginning in 2028, which means they may have to issue some of that 120 million of equity if they don't decrease the cash burn rate. So, what's the takeaway? While the company has positive momentum, generating positive cash flow in 2028, investors are left with significant risk and uncertainty over the next 4 years. Let's hop in the model. All right, cash flow statement. So again, we have negative net income, which obviously is going to drive negative operating cash flow. We don't see much in terms of CapEx. Something to be aware of is this massive equity issuance that we've seen over the last several years. This is not something that's going to be sustainable because it's going to continue to dilute shareholders. Ideally, they start generating positive cash flow, which we're projected to do in 2027. That will decrease the need to raise money via equity. All right, forecast drivers and DCF assumptions. The base case was run at the midpoint of management guidance and equates to 60% top line growth. Cost of goods sold and sales and marketing are decreasing as a percentage of revenues, but research and development needs to be reined in. The company has an extremely high beta of 2.75. It actually reminds me a lot of Tesla in 2015, 2016. It's a very risky company, and that's a big warning here. The variance in value is pretty wide. We went with a terminal multiple of 8 times last 12 months revenue based on the all-time low revenue multiple that occurred in 4Q22, 1Q23. We're going to see this next in the DCF valuation. So what's the takeaway? Conservative assumptions equals conservative results. Let's hop in the model. So as we mentioned, management has given revenue guidance 82 to 85 in 2024, 155 to 175 in 2025. So we're obviously going to go with what management says. And then that equates to a 52 to 68% run rate growth. So we ended up going with the midpoint in our base case of 60%. As mentioned, the beta is very high, 2.75. They have a pre-tax cost of debt of 13.5%. It's a very large spread over the prime rate, 575 basis points over prime. Also, in addition, we see that they have almost 40 million of debt. This actually came through the 2 acquisitions that they made. But in spite of that, they have 136.4 million of cash, which is pretty good. And then lastly, we talk about the revenue multiple. This is very important. I looked at the last 10 quarters from 2Q22 to 3Q24, and I excluded the high and low. The average revenue multiple was 24.7, the low 16.2, the close 25. The all-time low ever was 8 times. That was in 4Q22, 1Q23, around that area. So I went with that, and it's a super conservative multiple. Unlike our other companies that we've looked at in the past, there's no comps for this company. It's really a company of one. So we have to go with their historical multiples. All right, DCF valuation. We ran 3 scenarios, bear, base, and bull, with the current model at base. Future cash flows are discounted back to today to get to total enterprise value. We strip out net debt to get to equity value. The company has high revenue growth, lots of cash, 136 million, and upside potential. But is it worth buying today? The stock is up over 3x year to date and 57% since our last valuation in July. Wall Street has SoundHound at a median of $8 a share, which is a 23% discount. What does our analysis show? Let's hop in the model. All right, y'all, DCF time. What? So as I mentioned, we only have 4 years because we did a pro form of 2024. It's practically 2025 right now. We see negative EBITDA. It becomes positive in 2028. We strip out DNA. We also take into account cash taxes. We add back DNA. We take into account changes in operating working capital as well as CapEx. We then calculate free cash flow to the firm. We have our terminal value, which is 8 times our terminal revenue. We discount those cash flows by the discount factor to get us the present value of cash flows. We add those together to get a total enterprise value of a little over $3 billion. We strip out the debt. We add the cash. We strip out non-controlling interest. We add associate investments. We get an intrinsic equity value about $3.1 billion. We divide that by the current shares outstanding. We get an implied share price of $8.50 compared to the recent close of $6.51. That's an almost 31% discount and is a buy rating. All right, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and WACC versus the terminal multiple. 4 out of 50, or 8%, showed a sell rating. 11 out of 50, or 22%, showed a hold rating. 35 out of 50, or 70%, showed a buy rating. We ran each of the 3 scenarios equally weighted, got a weighted average value of $8.60, which is a 32% discount. So what's the takeaway? Utilizing conservative assumptions, we show a buy rating for the stock at a significant discount. Let's hop in the model. All right, obviously what we like to see, lots of green in our sensitivity analysis here. We go from the management low of 52% to the high of 68%. We have CapEx midpoint of 1%. So the bulk of this ends up being green. We have a little bit of red here, but this is like a super draconian low terminal multiple. So I'm not too concerned about that. Very high weighted average cost of capital. In spite of that, the vast majority show a buy rating. And last but certainly not least, we have our scenario analysis. So in the bear case, we actually show it at current value. We have a base at 850, which is a buy, and a bull at about 1080, which is also a buy. We do a weighted average, we get 860. It's a 32% discount, which is a significant buy rating. All right, the wrap up. Wall Street has SoundHound at a high of $10, which is a 54% discount, a median of $8, which is a 23% discount, and a low of $6, which is an 8% premium. The stock has shown massive volatility with a beta of close to 3 and increasing over 3 times year to date. It has a 52-week range of a low of $1.62 to a high of $10.25. Now, you should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice. That being said, I do not currently have a position in SoundHound, but it is a very interesting AI investment opportunity. I honestly look at this very similar to Tesla in 2015, 2016. The financials were simply too scary to invest. But if you believed in Elon Musk and his vision and rolled the dice, you were compensated quite handsomely. Insiders at SoundHound own 11.3%, but management hasn't been buying the shares recently. We have a range from a bear case scenario of 651, 6% upside, to up to 66% upside, 1078 in the bull case. The upside reigns across the board, but there's a ton of variance in these assumptions. This is a very exciting, though volatile company with a market-leading position in a niche space of AI voice technology with 150 billion market potential. With NVIDIA as a partner and investor, and some of the world's largest well-known brands as customers, I'm excited to see the future of SoundHound over the next few years and beyond. If you like this and want to see another in-depth stock valuation, check out my super microcomputer model here or my SoFi Technologies model here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.